And good morning, everybody. Yeah, it was quite a head scratcher for us looking at that gain after the company reported a 15% decline in their net profits, and that's a 10-year low. And that was actually in line with their downgraded guidance of the first half. Now, while this result did beat our and consensus expectations by 5%, if you actually troll through the accounts, you actually see that a divestiture as well as lower OpEx actually contributed to the beat. So the quality of definitely the earnings beat, so to speak, is definitely questionable. However, the results weren't all obfuscated. It was encouraging signs, I would say, in the second half. Organic constant currency growth with some green shoots coming through there, which was, like I said, good to see. Management was targeting 3 to 9% top line growth, but that is in a 2 to 3 year time period. So what about the present time? They did target 2 to 4% on the top line, equates to earnings growth of between 2 to 17%. Now that is a very wide range, obviously. Doesn't really instill a great deal of confidence in us that they're going to hit that. And if we do rebase fiscal 16's earnings to the underlying business, as I said, it was kind of complex, given there was a divestiture in there. The range moves to -3 to 11% growth into fiscal 17. So really, we may not be at a trough in earnings. I think investors really believe that we are at a trough at these earnings. So it may still go backwards into this year as well. And with management kind of flagging that the macros remain challenging, they did say the U.S. is going backwards still. Manufacturing's in the low. They said Europe is soft. Emerging markets, which is 25% of these earnings, are mixed. And the shares spiking higher yesterday. Now the shares are trading at 15% above their long-term average on our revised numbers. We did retain our hold rating. And just quickly, I'll just comment on the surprise that the company did appoint Goldman Sachs to look at options in relation to divesting possibly its sexual wellness division. This is the division, obviously, that makes condoms, lubricants, and vibrating devices. Represents about 13% of the company's overall profit. Very interesting. Obviously, it did arouse the market's interest as well with this result. But I would say that the timing is very interesting to me because, as I already said before, I don't think Ansell can really compete with the consumer packaged good companies like the Ricketts Bentzakers and the Church & Dwight's because they don't have the bandwidth. But like I said, this division is truly a profit center for Ansell. It's the fastest growing division. It puts up margins that are above the company's average. It's doing quite well. More importantly, we should be asking what will it do with the profits if this company or division, is divested. Very interesting because Ansell in the last 5 years under the new management team has been a serial acquirer. So you can expect that this company would go out and buy with those profits and not put them back into capital management efforts. So just something to look for there.